What happens when session timing and technical confluence align perfectly? You get trades like this: clean, high probability, and almost too good to be true. This setup was all about London Open meeting a major supply zone, and when those two things come together, the market tends to move fast. Price was sitting right inside a key supply level, and I knew this was where smart money would likely step in. Now, here's where most traders hesitate. They see price reach a zone, they know it's a strong area, but they second guess themselves. Either they wait too long or they jump in without confirmation and get caught in the wrong move. But if you understand how sessions opens interact with smart money levels, you already know where price is trying to go. Let me show you exactly how this played out and why I executed with full confidence while most traders were still questioning whether they should enter or not. This wasn't a trade I found last minute or decided to take randomly. I had this setup planned days in advance. At the start of the week, I shared this with my inner circle. I already mapped out this zone, and I knew that if price came back here at the right time, I'd be looking to execute. The entire community knew about it. Let me show you what I have said to them.
So if we do see price coming somewhere into the zone, here or even the one higher, then we can continue to the downside.
But now let's talk about structure. We were in a short-term bearish move, but on the higher time frame, the overall trend was still bearish. That meant I wasn't just taking a sell from a random level, I was following the bigger picture. Most traders make the mistake of reacting to the market in the moment instead of anticipating it. They wake up, look at the charts, and just trade whatever they see. That's why they always feel lost and end up chasing price. But when you plan your trades in advance, you don't need to force anything. You already know what you're waiting for. So when price reaches your zone, you're just following the plan. That's exactly what happened here. Now, this is where things got interesting. Price finally tapped into my supply zone, and at this point, I had two choices. Either I enter immediately or I wait for confirmation on a lower time frame. A lot of traders would see price hitting supply and just jump in without thinking, but that's where most mistakes happen. Just because price touches a level doesn't mean it's ready to drop. Smart money knows this, and they use it to trap impatient traders. So instead of rushing in, I waited. I dropped to a lower time frame and watched for signs that sellers were actually stepping in. And the moment I saw price starting to slow down and reject the level, I executed. No hesitation, no overthinking, just followed my rules. Now, a lot of people struggle with this part. They second guess their entry because they don't trust their analysis. But the key to confidence in execution is having a solid plan before price even gets to your zone. If you're questioning your entry while you're taking it, you're already setting yourself up for failure. The second I got in, price started moving in my favor. But here's where most traders mess up. They think once they're in profit, the trade is safe. That's not how smart money moves. The market doesn't go straight to your target. It tests your patience first. So right after I entered, price started moving in my favor almost immediately. It was a clean reaction off the supply zone, and at first it looked like it was going to be a straight drop. But of course, the market never makes it that easy. At this point, most traders would start feeling confident. They see the trade going in their direction and they think it's an easy win. But here's the reality. The market always finds a way to test your patience. Not long after my entry, price started pulling back. Now, for me, this wasn't a problem. I already had my stop loss in place. I knew my risk and I was following my plan. But for traders who don't have a solid system, this is where fear kicks in. I guarantee that a lot of people in this same trade would have started panicking the moment they saw a retracement. Some would close early thinking the market was reversing. Others might even flip their bias completely. But what was actually happening? Smart money was just clearing out liquidity. If you looked at the lower time frames, you'd see price taking out short-term highs before continuing the move down. This is something I expected, so I had no reason to react emotionally. This is why patience is one of the most important things in trading. Just because price moves against you for a bit doesn't mean your setup is wrong. If you've done your analysis correctly, you have to trust it. And that's exactly what I did. I held my position, and soon enough, price continued in my direction. The move was happening, but I still had to manage it properly. Now, let's talk about the exit. I wasn't just looking to take profits randomly. I had a plan. My target was set just below a major demand zone, which also aligned with a liquidity pool sitting underneath. Here's why that mattered. Smart money doesn't just move price, for no reason. If there's a buildup of liquidity in one area, chances are that's where price is headed. And in this case, there was a clear reason for price to drop lower before any potential reversal. As price approached my target, I already knew I wasn't going to close early. I don't close trades emotionally. Either it hits my TP or I let my risk management do its job. And that's exactly what happened. Price tapped into the demand zone, filled liquidity, and I was out of the trade. Now, a lot of traders struggle with exits. They either take profits too early because they're scared of price reversing, or they get greedy and hold too long, watching their profits disappear. Both mistakes come from not having a structured plan. If you don't know exactly why you're exiting a trade, you're trading emotionally. And if you're trading emotionally, you're just gambling. For me, this trade confirmed something that I always focus on. Blending different confluences together is what gives you an edge. If you only focus on one thing, whether it's smart money, structure, or liquidity, you're missing half the picture. The market isn't one-dimensional, and your analysis shouldn't be either. At the end of the day, this wasn't about just taking a trade. It was about executing a plan and following it with confidence. So, what's the biggest lesson from this trade? Having multiple confluences is key. You can't just rely on one thing and expect to be consistently profitable. If you only look at smart money concepts but ignore session timing, or if you focus on structure but don't consider liquidity, you're leaving out critical pieces of the puzzle. The biggest mistake traders make, chasing price after the move has already started. If you knew this setup was forming but you hesitated and tried to jump in late, that's exactly how you get caught in bad entries. The market will punish impatience every time. That's why the best thing you can do is just wait for the next trade. The market is always giving new opportunities. There's no need to force anything. Now, if you're serious about improving, here's what I want you to do. Go back and study everything I just showed you. Look at how price reacted at key levels and compare it to past setups. Most importantly, start thinking about how you can refine your approach. And now, let me ask you something. What's the biggest challenge you have in trading right now? Is it entries, exits, holding trades longer? Drop a comment below and I'll personally respond to help you out. Oh, and if you found this breakdown useful, make sure to check out my next video where I go even deeper into smart money moves and how to avoid retail trader traps.